There are two ways that we really get context over what the market is really doing. One is to look at the big picture in terms of the larger structure, wave counts, and have a bigger bias on which side the market is headed. But when we go through a correction like we've done so recently, we look also at the small picture, and the first sign of a trend reversal comes in when we are able to see a 5-wave impulse. So actually looking at the hourly chart of the Nifty, and I'm marking here what looks like a 5-wave move to the upside. Subsequent to that, last 2 days we've seen a sort of 50%, little more than 50% retracement of that advance. But this initial 5-wave advance is the first signal that the trend might be changing, and we use that as an indicator as to where we might be headed. Now, you can wait if you want for some higher retracement to get really taken out, like the 50% of the entire fall or 61% of the entire fall. But by the time you're actually over there, you would have crossed 17,900. And if you have done that, then what is your risk reward to taking a view on the market, especially if it ends up being counter trend in nature? So even I'm not getting into whether I believe it's counter trend or not counter trend, but what I'm trying to say, that's the common argument right now after every correction, that is the correction counter trend or is it the start of an impulse? My answer is get it right early, and that's what Elliott waves allows you to do, and your risk reward therefore becomes favorable at the time of entry. And in doing that, if something does go wrong, you have enough room to really maneuver and cut out of the deal, so you can actually move out. You might still not lose money. For example, if you wait for a breakout above 17,900 or above 17,600 and it ends up becoming a failure, so you get something like this, okay, then the later you're in that, the odds of getting stuck or actually closing out at a loss are higher. But the sooner you're able to judge that something like that is happening in terms of the trend from the low point here, because that's almost 16,900 to 16,800 at the lowest point, and when you move from there to 17,900, it's a 1,000-point move. And how early in the move can you say that you're going to do a bounce of some kind with a counter trend or trend, and then you can actually be early in the trade such that you can actually manage around it better. So I would like to believe that this is the start of a new trend up. I would like to think this is 1 and 2. Okay, now you may think, okay, no, this is still part counter trend, and that argument can go on and on. But at least if you're able to spot an impulse early, then what you're able to do is on the pullback from the first impulse, you're able to take a trade and position yourself at a point where the risk reward is more favorable and gives you room to maneuver. So I think that's sort of overall part of risk management, because when your risks are low, the amount you're going to lose is also lower than if you were actually doing breakout trading. So breakouts or waiting for final and further confirmations is sort of not a working strategy, because the losses will always tend to be higher. So just as a part of keeping losses low is where Elliott waves also plays an important role, apart from having the big picture view as to whether the trend should be up or down. So something very similar we also did with the dollar chart. The dollar index ended up looking like a 5-wave decline. So I ended up marking this as 1, 2, 3, okay, 4 and 5. So moment we've done this 5-wave move down for the dollar index, the first thought is this the start of a trend? Now you've got some confirmation, which is the daily momentum indicator. In fact, I should say Rohit's momentum indicator, because we have that coined and now published on the Trade Tiger platform. So if you're not yet using Trade Tiger from Sher Khan, you get my proprietary momentum indicator on it now, and it's called Rohit's momentum. There are 2 variations to it. We will at some point do a webinar with them, which is in the works, which will explain the usage of those other 2 variations. But if you just start with the base indicator, you'll sort of get quicker, faster and smoother signals. And I've been using it for more than 20 years. So that on the daily charts would have already crossed over and given a sell signal along with this 5-wave decline. So you have a trend reading, but what you're looking for is the first thing that a 5-wave move means is that you're going to get another 5-wave move, because whether it's wave 1, 2, 3 or ABC, 3 waves are a minimum in any trend. So even if it's a counter trend or a pullback, you get a 3rd wave. If it's a trend, you'll get 3, 4 and 5, and that way second waves basically give you an early entry, just like we mentioned earlier. So something similar that I've been seeing in the dollar index, that it did a 5-wave decline. It's attempting to do a pullback for several days. In fact, it's almost beginning to look like a triangle. Now, I would hope it's not a triangle, because then it means it is A, B, and C, which means it would only be a corrective decline. But too early to say that. It can also be a complex pattern. But broadly speaking, till we don't get another impulsive down move, whether it's a third wave as C or 3, the move down is not complete on the dollar index. And right now we are just 2 days ahead, rather 1 day. I mean, 2 days technically. It's already the evening of the 14th. So by tomorrow night, you'll have the Fed rate announcements, or the meeting announcements, which will then have an impact on financial markets on Thursday. So just ahead of that, and the dollar plays an important role in terms of their positioning. The setup is actually for a dollar decline in the short term. So that's interesting. The dollar is already signaling that it wants to go down and not up, just as tapering kicks off. But tapering, one is they've already thought that they're going to have a timeline, but not a defined level, something they'll decide meeting to meeting as to how much they want to pull back. And they've also given a quote in between saying that they could speed up or slow down the pace. They're actually thinking of speeding up, is what it sounded like in their testimony to the Senate. So now, will they really speed up or not? That's what we'll actually figure out, because now that the market's been told we're going to speed up and been made to fear about it, if they actually don't, it would end up having a positive connotation for the market, because the market starts pricing that in advance. The question is, what is the dollar going to do in that situation? I mean, why would the dollar fall when you're tightening? So the dollar is telling something different, probably based on how various central banks are going to move over the next couple of days, because they're all going to be making some announcements. And then again, wave counting, sometimes we do get things wrong. So then if the dollar somehow manages to go higher from here rather than lower, then this ends up being wrong. But so far, the setup on the daily and hourly charts are indicating some more downside before it actually goes up.